Hey there, I wanted to quickly talk about how I made money in GameStop about a month ago using put options. Now, typically put options will increase in value when the stock goes down. However, the puts options in GameStop actually increased in value as the price rose. So I sought out to find why it was doing that. Unfortunately, I found out a bit too late. Right here, I have a graph of the $1 strike puts expiring January 21st of 2022. So this contract has a year left until it expires. In the graph that I have, the price actually got up all the way to 40 cents. Uh, I actually sold contracts at 20 cents and was able to buy them back a week later at 8 cents. And the reason why I did this was because at first glance, if the price is going up, why would the odds of the company going bankrupt increase? So I had to ask around, and what we came up with was that GameStop, if they uh, if they diluted their shares and raised capital, when the price fell down, or if it ever fell back down, to its normal range of, let's say before everything, it was around $4, it might settle in a range between $1 to $2, which is what gave these puts value along with just the volatility that was going on, which volatilities at those levels, the numbers just start to break down, and that's what caused this huge spike in price that just didn't make any sense. And as you can see, even though the price of GameStop is still well super high, I think it was at like 120 when I last looked at it the other day, uh, far away from $4 that it was before. uh, these contracts have gone up and then back to normal. So I wanted to quickly explain why that happened and how I was able to make some uh, really clever choices with some others. So the concept here is that as the price increased, so did the chance that they would raise capital and issue more shares, which is the point of the stock market anyway. So if I could find out uh, one reason or another of why they would or would not raise capital, that would tell me which side of the trade to take. I decided to sell the contracts at the $1 strike for $20, which means that a year from now, if the stock price stays above a dollar, then I will make $20 per contract. If the price, or in this case, let's just say the company goes bankrupt a year from now, then I will lose $80 per contract, making my risk reward 80 to 20. Okay. And the the best part is I found this out a little bit too late. If I had been looking for this sort of thing before, it was possible to get a risk reward of 60 to 40, which is really good. So I basically set out to find why would GameStop raise capital and why would they not raise capital. So I made a post over here on this Facebook group, and I just asked, why hasn't GameStop raised capital? I did this, I think it was either the same day, it was definitely the same day I made the trade. I don't remember if I posted this before or after I actually did it, but it doesn't really matter. And the comments that stood out the most would be this comment right here, saying that no one will underwrite them. And after talking to more people who actually work in the industry, the consensus was, yes, there is not a very good chance that they will end up raising capital, which means that the market is implying that they are, and I assumed that they were wrong. And this is why options are so fantastic, because I couldn't make this sort of bet with just buying and selling shares, especially because selling shares was completely out of the question, and buying shares at 400 also didn't make any sense. But because of my knowledge of options, I was able to set up something that worked for the type of bet that I wanted to make in that. So, if you're interested in learning about options or maybe just the stock market in general, feel free to shoot me an email that I've linked down below, and I will set you up in my new Discord community where I offer free lessons and we try to find trades just like this one. Have a good one. Hey, if you made it this far, here's a cute picture of a hedgehog on a laptop. Okay, bye.